Warren Buffett said, "Someone's sitting in the shade today because someone planted a tree a long time ago." These wise words are a key to financial independence, especially when it comes to investing in dividends. Today, you will find out a quick way to make $2,200 monthly in dividends. Don't forget to watch it till the very end so you don't miss out on any strategy. Let's jump right into it. So what is a dividend? It is like a reward for owning a piece of a company. It's some money the company gives to its shareholders from its profits. Sometimes instead of money, they might give more shares of the company. Dividends are usually given out every few months, but it could be every month or once a year. The company usually decides how much to give before they pay it. They do this to show they're doing well financially and to keep investors happy. But not all companies give dividends. Big ones like Amazon and Alphabet don't do it at all. In easy words, take an example of a company that bakes a big cake, and instead of keeping the whole cake for itself, it decides to share some slices with the people who invested money in the company, like its shareholders. These slices of cake represent the dividends. If you don't know, Warren Buffett is fond of companies that steadily increase their dividends over time. These businesses consistently boost their earnings annually and choose to share these higher profits with their shareholders. Finding such companies with strong characteristics can be appealing to Buffett. When these stocks are priced fairly, they can offer remarkable returns for shareholders. Fortunately, investors can emulate Buffett's strategy by observing Berkshire Hathaway's publicly available stock portfolio, disclosed by the Securities and Exchange Commission. Here are 3 dividend growth stocks from the portfolio that offer compelling long-term investment opportunities. 1. Apple. Berkshire Hathaway's largest equity holding, Apple, has been a favorite since Buffett's initial purchase in 2016. Known for its robust iPhone sales and expanding services segment, Apple reinstated its dividend in 2012 and has consistently increased it since. Moreover, the company's aggressive share repurchase program, totaling over $600 billion, has bolstered earnings per share and instilled confidence in investors. With a commitment to achieving net cash neutrality and substantial free cash flow generation, Apple remains an attractive choice for dividend growth investors despite its premium valuation. 2. Visa. Holding Visa shares for over a decade, Berkshire Hathaway has benefited from its consistent dividend increases and market outperformance. As the world's largest payment network, Visa enjoys a competitive advantage that is hard to replicate, especially by new entrants. The ongoing shift towards digital payments further strengthens Visa's position, with its robust free cash flow supporting dividend growth and significant share repurchases. 3. T-Mobile US. A recent addition to Berkshire Hathaway's portfolio following the Sprint merger in 2020, T-Mobile stands out for its impressive free cash flow growth and market leadership in the wireless network sector. With a strong focus on expanding its 5G network and enhancing its home internet business, T-Mobile anticipates substantial free cash flow generation in the coming years. But knowing about these dividends is useless unless you know the strategy to invest in them. Number 1 strategy. Renowned investor. Warren Buffett's every move is closely scrutinized by the market, making his recent portfolio changes particularly noteworthy. During the third quarter, Berkshire Hathaway, Buffett's holding company, shed some of its most recognizable holdings, including General Motors and Johnson & Johnson. This shift signifies a more cautious approach, with the company selling nearly $7 billion worth of shares while only buying $1.7 billion. Despite the selling, Buffett remains committed to his value investing philosophy, evidenced by the continued dominance of blue-chip companies like Apple and Bank of America in his portfolio. Notably, Berkshire ended the quarter with a record cash pile of $157.2 billion, indicating ample resources for future acquisitions that meet his strict criteria: consistent earnings, strong returns on equity, and honest management. While the reasons behind the recent sales remain unclear, one thing is certain: Buffett's investment decisions continue to captivate the financial world. When it comes to dividend investing, blue-chip stocks are like the trusted anchors of a financial portfolio. These established giants, like Johnson & Johnson, healthcare 2.98% dividend yield, Coca-Cola, beverages 3.13% dividend yield, and Altria Group, Consumer staples, 9.15% dividend yield, boast a long history of consistent payouts, offering investors both reliability and steady growth. Take iconic investor Warren Buffett as a prime example. His holding company, Berkshire Hathaway, prominently features blue-chip stocks like Coca-Cola, reflecting his philosophy of prioritizing companies with robust profitability and consistent dividend payments. This focus on stability aligns with the goals of many income-oriented investors. Imagine a scenario where you, seeking a monthly income of $2,800 from dividends, invest equally in these three blue-chip stocks. To achieve this, he would need to invest approximately $661,188. While this initial sum might seem substantial, it's crucial to remember the inherent safety associated with blue-chip investments. Not only would this portfolio provide you with a reliable income stream, but it would also likely experience growth. Number 2. Strategy. Blue-chip stocks, while offering stability and reliable dividends, may not be the only path to achieving your income goals. Enter the realm of dividend growth stocks, a category particularly enticing for those seeking to emulate Warren Buffett's long-term wealth creation strategy. Unlike their blue-chip counterparts, these stocks are known for their potential to consistently increase their dividends over time, making them ideal for investors seeking a growing income stream that outpaces inflation and preserves purchasing power. Think of it this way. While blue-chip stocks offer a reliable paycheck, dividend growth stocks offer a salary with potential raises. Examples like MSCI, Financial Services, 1.05% yield, known for its global market indexes and software, or Arbor Realty Trust, real estate, 12.52% yield, specializing in real estate loans, offer the potential for dividend growth alongside income generation. Even the diversified giant 3M, industrials, healthcare, consumer goods, 5.84% yield, famous for its adhesives and other products, falls into this category. While the average dividend yield of these three examples, 6.47%, is slightly higher than the blue-chip portfolio, the investment required to achieve the same $2,800 monthly income, $33,600 annually, is lower. In this case, you'd need to invest approximately $519,450 compared to the $661,188 for blue chips. This is because the potential for future dividend growth allows for a lower initial investment. Let's take our example to the next level and explore the power of compound growth. We'll stick with our dividend growth portfolio with a 6.47% yield and a 15.3% annual dividend growth rate, and assume the portfolio's value also increases by 3% annually. So basically, you don't need to invest the entire $519,450 upfront. Instead, you can start with a $10,000 initial investment and contribute $10,000 annually. So within 10 years, you will reach your $2,800 monthly dividend goal or $33,600 annually with a total investment of $110,000, $10,000 initial plus 10 years of $10,000 contributions. The portfolio's value will actually be around $254,500. This strategy aligns perfectly with Warren Buffett's philosophy. He emphasizes investing in companies with strong growth potential and sustainable business models. Dividend growth stocks often embody this principle, being established companies with robust models that allow them to raise their dividends consistently. By investing in such stocks, you benefit from potential capital appreciation and enjoy a steadily increasing stream of income over time, mirroring Buffett's buy and hold strategy of acquiring quality businesses for the long haul. Number 3. Strategy. Now, if you are looking for a shortcut dividend strategy, then covered call ETFs might be your ticket. These exchange-traded funds invest in established companies like Apple or Microsoft, but with a twist. The fund managers sell call options on these stocks, generating income from the premiums, which are then paid out to investors as dividends. This strategy can lead to significantly higher yields compared to traditional dividend options, especially in stable or slightly growing markets. For instance, some popular covered call ETFs boast yields exceeding 10%, significantly higher than the average stock or ETF. However, this higher yield comes with a catch, which is a risk. The ETF forfeits any potential gains above a certain price in the underlying stock by selling call options. So, if the market soars, you might miss out on significant profits. Think of it like this. Covered call ETFs offer a shortcut to high dividends, but it's a faster lane with more bumps. While they can be a valuable tool for income-focused investors, it's crucial to remember they should be part of a diversified portfolio due to the inherent risks. In short, covered call ETFs offer a tempting alternative for dividend seekers. In conclusion, instead of investing in the stock market as a whole, Buffett believes that investors should seek out companies with a solid dividend history. What is your take on this approach? Will you consider it applying to yourself? Comment in the box down below. We hope you found the information valuable and insightful. If you love the content and want to stay updated on more financial tips and strategies, do like this video and subscribe to our channel.